Let's rock and roll.
All
With the
right.
Ramones. With the Ramones.
There you go. That was a good band.
That was a good band.
Hello.
Hey guys, how you doing?
Good. How are you?
Oh, just peachy. Thank you.
Yeah, there you go.
Never know when people say that if that's just sarcasm or if that's just truly how they express how good things are.
No, it means I'm plump and juicy.
You're plump and juicy. There you go.
Okay, now we're getting into the realm of too much information.
Yeah. Okay, Mandalorian. We'll just leave it at that. That's the image I have of you.
Oh, I know. I can never figure out how to put my face on unless I go live or something. I don't know. I'm not technologically savvy.
Oh.
Oh, there's a little button down the bottom with video on it. You hit that,
Hey,
and your
Paul.
camera comes on. Back bottom left.
Oh yeah.
There you go.
Hey guys.
There you are. Hey, there's
Hey,
He's that
Jason.
handsome guy.
There's Jason.
Yeah,
Oh,
he does
I've got a background
exist.
too. I don't know how
I
that
thought he was. I thought he was just a voice from the future.
happened. I am the Mandalorian.
You are the Mandalorian. There you go.
Wow,
That's a good show.
We're getting into two
Yeah.
and three syllable words on this call. We're getting pretty sophisticated. It's too much from a guy from Nebraska.
Oh, that's hilarious.
Like I can say it, I can't spell it.
Yeah, I'm
I
horrible
can
at
say-
spelling.
Huh?
Yeah.
You think
Oh,
David's
I
over
was-
on the? Think David's on the live channel?
I'll check.
Oh, yeah. Oh. Well,
Of course he is.
interesting week
Is he
for
there?
sure.
I'll get
Yeah,
him.
that's his office.
Go get him.
David's office.
Go knock on David's door.
Yeah.
That's
And then-
hilarious.
No.
Oh. It's I'm gonna send out an email on Sunday. I'm gonna include the Discord, Platinum Discord link to it because I think a lot of people don't use it or don't have access to it for some reason. So I'm gonna send out a
I
new
know some
link. So if
people
you guys see it, that's all I'm doing.
You know what
Some
threw me
people-
off is on the platinum events, it had the link to both Kerry's and. So I went to the Kerry's meeting and I'm like, oh shit, this is a Kerry. There's two links on there, so I got thrown off. but-
Right.
Yeah.
I've started putting that there because a lot of people don't go down to the gold and look at it from that point. So
Right.
I had some people who were texting me during one of Kerry's calls and like, I can't find the link. I can't find the link. I realized they were platinum, so I include it as well. But I can try to make it a little more defined in the future. So
Well, I
Yeah.
realized after about 5 minutes.
No one else showed up.
Nobody was there. I was like, this is odd. Yeah,
You were early.
Yeah, right. Real
that was,
early.
yeah, it was pretty. What a turnaround
So-
here. I didn't expect this.
Well, we're not quite back to even yet, but we're getting there. You know.
I didn't expect
see.
it though. I thought it was gonna be a down day today. I thought it
Well,
was.
we're not done yet.
Yeah.
You know, we're
Yeah.
not done yet.
Give it a minute.
You saw what happened yesterday. You know, and so you know, the retail get in the morning, and they really got in today, and then the institutional get in this afternoon. We'll see what they want to do. And you know, next week and the week after are short trading weeks because we're going to close early on Tuesday both days for New Year's Eve and Christmas Eve, and then it'll be closed on Wednesday for Christmas Day and on next Wednesday for New Year's. A lot of the traders and the institutional guys are all going to be gone for the most part. We were gone when I worked in that business. It's very slower volume. And I was talking to David yesterday and I said, you know, for a swing trader, for me, this is the last week of the year for me because I'm not going to do anything in the next 2 weeks because my personal trading plan is based on a normal functioning market. And I don't mean that in a bad way, but one that's 5 days and everything's rolling and you've got your known market conditions, your reports and all that. This one, it's going to have less volume. It's going to have less participants. It's just going to be kind of slow. There'll be some window dressings maybe going on a little bit, in the technologies like we've seen. But for the most part, I'm done with it until the beginning of next year, and that's kind of the way the market goes. And most of the guys, they're taking the next 2 weeks off in the big trading house. And that doesn't mean the computers don't trade; they do trade, but it's just a different 2 weeks. And then the potential for starting the Santa Claus rally, and we'll see. That tends to move the market up 1 to 2%, based on history. But we'll see what happens this year. But I'm with Paul. With the whole shutdown thing looming, that just shows you the market really doesn't care about whether the government's open or not. It's strange, but and
Has there
frankly,
been any news? Do you know if there's any news on?
They're gonna try something this afternoon, and we'll see what happens. Maybe that's bumping it. I don't know.
Plan C?
I haven't heard anything else than that. Another kind of vote or something. But
Was this a part of that whole 1,500-page bill?
yeah, yeah.
Okay.
They were trying to do I forget, resolution something, and trying to push through. And in that bill was a lot of pork, and they've given themselves a raise. They were building a stadium in Washington, D.C. for the football team there. And just a bunch of stuff. And, some of the members got in. So it's not, no, that's not why we got elected. And so anyway, they'll have to work it out, but it happens all the time. If they would just do a budget like they're supposed to do, maybe we wouldn't have to do this every 6 months or year or whatever it is, kicking the can down the road, which is the big reason we are where we are today, with what happened Wednesday. So without further ado, I'll get rolling here. And we got a lot of charts and questions, I'm sure, and comments, and we'll get going here. So when you go back to what a change it is, like Paul said. So last Friday, a week ago, I went back to the headlines, and the headlines were: the three main indexes have set multiple record highs this year as investors flock to heavyweight tech stocks to capitalize on the hype around AI. And we talked about it last week. Some of that is window dressing, where a lot of these funds who have not kept up with the S&P have gone in, sold their dogs, and bought these guys to make it look better when their statements get to their customers, next month. So some of that was that also, I believe. And then, Wednesday happened last weekend, and the headline was: Jerome Powell killed off investors' sense of Christmas cheer Wednesday by offering up a gloomy outlook on inflation and interest rates that caused stocks to plummet. And I don't know if you guys watched that, but he lost me when he said that that the Americans didn't care about inflation. They cared about they weren't worried about inflation. They were worried about price increases or the prices of things. And I'm thinking to myself, he's got 400 PhD in economics. So the way the prices are up is because of inflation, and I just didn't get that part. But anyway, we had a quarter point drop in the rate. So the Federal Reserve cut its benchmark interest on Wednesday to a range of 4.25 to 4.5, bringing its decline since mid-September down 100 basis points or 1%. And Wall Street usually celebrates rate cuts as lowering borrowing costs drive spending, investing, hiring. However, the stocks went down, as we all saw, because the Fed officials projected only 2 cuts next year, down from 4 previously. Fed Chair Jerome Powell also said the central bank expects to ease its monetary policy more slowly in the months ahead. The NASDAQ plunged 3.6% and hasn't fared so badly on a Fed decision day since March of 2001. According to the Dow Jones market data, on that occasion, policymakers voted to slash interest rates by 0.5 point in a bid to revive the faltering U.S. economy, disappointing investors who were hoping for an even more aggressive cut. The S&P and Dow Jones Industrial Average had their worst such session since January of 2009 and March of 2020, respectively. Small cap Russell 2000 dropped 4.4% for its worst Fed decision day on record. Those aren't the only data points that capture the sense of the carnage on Wednesday. Wall Street's best known gauge of fear and uncertainty, the CBOE Volatility Index, or the VIX, spiked 74% for its largest increase since February of 2018. a bizarre session when anxieties about inflation snowballed into panic sell-off that caused the Dow to plunge 1,200 points. Last I looked, I think we're back up 800 so far today. I don't know if that's gone up or down. Meanwhile, during Wednesday, only 17 of the S&P 500 stocks finished Wednesday in the green, the lowest number of large cap winners since March of 2023. The Fed has been lowering rates to stimulate the economy and job growth, but too many rate cuts could fuel inflation, which is still stuck above the Fed's 2% target. So inflation and employment are really not going the Fed's way. It was interesting that I went and read the statement because I'm a geek and I do those things. And they started out with the economy is great. And then they went into, but inflation is high and it's stingy and we can't get it down. And we're starting to see weakness in employment and employment, and it went on about the things that they're charged with, which is inflation and employment. So I think that's why the market was a little confused, along with the Treasury, the 10-year Treasury, ever since they started with their 50 basis points rate cut in September. The Treasury yield on the 10 has just skyrocketed, basically. I think it's is it still around 4 or 5, somewhere in there, trend, as I imagine.
It was at 4.49
Okay.
just a bit ago.
So that's
Yeah.
not good because that's tied to mortgages and that's tied to credit cards. And so if you're trying to stimulate the economy, that's not going to help the regular people out there, get loans and use their credit card, which are already maxed out. So anyway, that's kind of what happened. And I'll go into a little bit how some of the charts actually helped us see this coming a little bit. We'll get into that a little later. Today, the PCE, inflation report came out. That's supposedly the Fed's favorite inflation indicator. Core PCE printed cooler than expected for November, up 0.1% versus 0.2 month over month, and held steady at 2.8% year over year. Okay, so it's not going down, not going up for the PC, at least year over year. But it's tied for the highest since April. However, headline PCE rose to 2.4% from 2.3%, its highest since July, and that's year over year. We did have some good news yesterday. The leading economic indicators provided us with some optimism. So for the first time since February of 2022, which is almost 3 years ago, the U.S. leading economic indicators was positive in November. Building permits and stock prices were the biggest positive contributor to the main index, while ISM new orders and yield curve were still notable drags. With November gains, the LAI no longer signals an impending recession. So, take that for what it's worth. Again, it's better than nothing. It's been down for a long time. The interesting thing about recessions is a lot of times recessions there's an organization, I forget what they're called, and they determine when we're in and out of a recession. And the majority of times they don't even know we're in a recession. They go back, we started this recession in March of 2023. They could do that and we could have been in one. Who knows? I think that everyone considers whether you're in a recession or not based on your own personal situation. And I think the old adage is a recession is when your neighbor gets laid off, or depression is when you get laid off. I think I've heard that a lot.
Yeah.
So on the other side, we talk about employment, okay? And Powell brought up, employment's, there's still jobs out there, and and the amount of jobs is coming down, and but we've only 4.2%. We expect next year 4.3%, and out further they went, they go out so far. I'm like, you guys can't even predict what it's going to be next month accurately because we have all these revisions. So anyway, I take that with a grain of salt, what they say in their dot plots and all that. But when you look at employment, remember back a while back, the Federal Reserve of Philadelphia, they go back and they clean up the numbers. And the last time they did it for the first quarter of 2024, so January through March, they cleaned up the numbers and they said, we overstated the amount of jobs by 818,000 jobs. Okay, so instead of 220,000 a month, we're only at 158,000 a month or whatever. Well, they went back and they do this every quarter for different quarters. So now they put out a report from April, May, and June of this year. So Estimates by the Federal Reserve Bank of Philadelphia indicate that the employment changes from March through June were significantly different, reading lower in 27 states compared with preliminary state estimates from the Bureau of Labor Statistics. Current employment statistics, according to the early benchmark estimates conducted by the Philly Fed, employment was lower in 25 states, higher in 2, and less changes in the remaining 23 states and the District of Columbia. So translation, there are 23 states that were unchanged. 1 was revised higher, 25 were revised lower. And so after it first revised at 12 months ending in March, okay, that was by 818,000. And downgrades extended into the second quarter of 2024 when Philadelphia Fed early benchmark estimates show that instead of a 1.1% gain shown initially during that time period, payroll jobs in 50 states and District of Columbia were actually down by 0.1%. And so we won't know the specifics of these revisions. Now, this is just the preliminary. Those will be revealed in February 7th. So we got another month and a half to wait when the final numbers are published at the national level. We do know that all jobs reported created in the second quarter were actually not. There were no jobs created at all if the revision is correct. And in fact, the U.S. would have lost jobs in Q2. So that's something that's going to be coming out, for the next administration to work with. But we've been watching these jobs, and that's why we go over this every week. We watch these reports. We go into the reports, the non-farm payroll. We find out that the jobs being created are not full-time, they're part-time. They're not Americans are not taking these jobs. It's foreign workers taking these jobs. You can go into the details and look at it. And so we only get the rosy part. We get the headline numbers. The next month, they revise them down majority of times. And so that's why we do what we do, because we need to know this stuff as traders, investors, because we have to verify, and trust but verify what we're seeing is true. And a lot of what I see, I think we need to dig into it a little deeper and make sure that we understand it the way it really is. We talk about initial jobless claims. Okay, they came out this week. They fell by 22,000 from the previous week to 220,000 in just the first week of December. And that's more than the market expected of 230,000. So the result, they say, was in line with the Federal Reserve's recent projections that a few interest rate cuts would be required next year, signaling the FOMC's view that inflation poses a bigger threat to the economy than a softer labor market. But I think what really causes a bigger threat to the economy is what the bond market sees. And the bond market is not tied to the Federal Reserve and what they do. The Federal Reserve, they mess with interest rates at overnight rates, short-term rates at the bank. They lend to the banks and banks lend to each other. The real issue that I think the bond market, if you see the 10 get up to 5% or more, it's going to be about the deficit and the debt. This week, the United States recorded a record high current account deficit of $310.9 billion in the third quarter of 2024, widening from the revised $275 billion in the previous period and exceeding market expectations of $284 billion gap. Secondary income deficit increased to $61.8 billion, up from $46 billion, driven by higher general government transfers, particularly for international cooperation. That means war. Okay, we're sending a lot of stuff around the world for war. And that's, billion here, billion there. Pretty soon it adds up to, some real money. So again, we continue to spend. We're watching our treasuries, more and more treasury bills. If you get into treasuries, and I put out what Fidelity offers on treasuries and U.S. auctions. I try to do it every Tuesday, and you notice significantly that we're not at 5.57% anymore. We're at 4.29, to the point that I've changed some of my money strategies into CDs where I can get. I think I got 4.4 or 4.45 this week for a 30 days CD, Bank of Kentucky or somewhere. So the Treasury, and you saw the Treasury auctions this week, they weren't that good. And so Treasury buyers are seeing the same thing we're seeing lower rates in the short-term Treasuries. So it's forcing money to go where the value is and get that extra couple tenths of a point, at a bank CD. So that's what we're seeing there. Okay. Home. We've had a little bit of happiness in the existing home sales in U.S. rose by 4.8% from the previous month. That's good news. Housing starts, however, unexpectedly declined 1.8% to a seasonally adjusted annualized rate of 1.2 million units, the lowest in 4 months. Okay. So again, starts for houses with 5 units or more apartments fell 24.1%, okay, offsetting a 6.4% gain for the single family home segment. Mortgage rates, we're seeing again with treasury bills. Average interest rate for a 30-year fixed rate mortgage in US rose to 6.75% in the week ended December 13th, 2024, from 6.67% in the previous period, which was the lowest in 7 weeks. If you want a jumbo loan or a 30-year mortgage for homes over 760,000, that was up 7.03%, up 7 basis points. And the average rate for a 30-year mortgage backed by a Federal Housing Administration was 6.72%, up 2 basis points. So again, housing is a big sector, and the way housing goes, you know, new houses, new starts, they create a lot of jobs. They require a lot of resources in wiring and shingles and flooring and drywall and, you know, concrete and all that. So it's a big, big market. So that's why we follow housing. US GDP expanded at an annual rate of 3.1% in the third quarter. That was higher than in 2.8% in the second estimate. It was the largest growth rate so far this year. And government consumption was also revised higher to 5.1%. So if you go back in and, you know, that's the headline. If you go back in and look at GDP, you can see that government spending has gone up pretty much a lot. And that is included into the GDP figures. We're sending a lot of military equipment and others overseas. We have increased our entitlements. We've increased just spending. You can see, you know, you can go to the deficit and just see what we're spending month by month and see where that's coming from. So a lot of the GDP is being driven by U.S. government spending and not as much, in my opinion, by consumers. U.S. retail sales, that was big. That was on Monday, and they rose 0.7% in November. A solid increase and higher than October's 0.5%. Sales jumped 2.6% at auto dealers, which drove most of the gains. Some of that demand likely reflected a need for new cars and parts in the Southeast slammed by Hurricane Helene in October, as well as healthy incentives provided by car dealers. Big discounts in many retail chains also attracted some consumers. At the same time, there were some signs of consumer caution as sales in grocery stores, clothing shops, and restaurants fell. Outside of car dealers and online retailers, sales gains were modest. And one thing you need to remember about sales reports, they aren't adjusted for inflation. So as inflation is going up, 2 to 3% each month over month, some of that increase in sales reflects higher prices. When we look at production, capacity utilization in the U.S. fell to 76.8% in November. That's the lowest reading since April of 2021, and downwardly revised from 77% in October. Okay, that rate is now 2.9% below its long average run. So capacity of factories and businesses is down. U.S. production, industrial production in the United States fell by 1/10 from the previous month in November to extend to the 0.4 contraction in October, third consecutive decline, and contrasting from market expectations of a 0.2% rise. The result was consistent with other surveys that pointed to softness in U.S. manufacturing. I don't see Bob here, but Bob is our manufacturing guy. Not you, Bob, from New York, Bob from New Jersey. But and again, factories and manufacturing has been really a drag in this economy, and it's been a bad for quite a while. The S&P Global Manufacturing PMI fell to 48.3 in December from 49.7 the previous month, well below market expectations. The result extended the contractionary momentum for U.S. factory activities for the 6th month in a row, sharp contrast with the resilient service sector. New orders for manufacturers recorded another month of contraction, driving output to sink to its lowest level since August of 2009, when excluding the pandemic shock during the second quarter of 2020. Employment rose at a slower pace, despite lack of staff being responsible for lengthening of lead times. On the price front, higher costs for raw materials supported inflation for the sector. So we see this a lot in manufacturing. We're seeing they're reporting lower unemployment or lower employment, lower weeks work, the hours worked in weeks, and they're also showing that the prices that they're paying are higher, which will eventually become part of the PPI and then get into the CPI. So we still do have an inflation issue, at least in manufacturing, and they're seeing that in the Fed, and that's what happened on Wednesday. Service sector is a bright spot. The service sector PMI rose to 58.5, and that was up from 56.1. The reading pointed to the strongest growth in the service sector since October 2021, as new orders for services rose at a rate not seen since March of 2022, and employment increased for the first time since July, when the price front's cost growth slowed, and hours worked remained about the same. So services, I mean, we are more of a service industry. So again, it's a large part of the economy. That's good news. But services, again, tend to be lower paying jobs that are not full time, okay, and with the benefits that a lot of people want. Had some Fed manufacturing regions come out. The Philadelphia Fed manufacturing index plunged to negative 16.4 in December, the lowest level since April 2023, and way below expectations of 3, signaling further weakening in regional manufacturing activities. Employment index edged down but remained positive, indicating continued, albeit slower job gain. Meanwhile, the prices paid index rose to 31.2, showing elevated input costs, while the prices received index fell to 7.3, third consecutive decline. Kansas City activity declined modestly in December. Price increases accelerated from last month, and raw material prices continue to increase at a faster pace than finished product prices. Again, inflation and producer prices. Month over month composite was -4 in December, down from -2 in November, and unchanged from -4 in October. Most month over month indexes were negative. Production index ticked down from -4 to -5, while new orders fell from -9 to -17. Employment rose slightly, while backlogs continue to sink at -22. Okay. Most other indexes decline with production volume of shipments, new orders, and backlogs all below -20. So again, the reason that I go over these is because on the macro side, I know that we look at technicals, but these things matter, and it mattered. Known and unknown market conditions can be critical to our trading and our investing. So you need to know what's going on out there, so that when someone tells you, oh yeah, everything's great, or this is bad over here, you can either agree or disagree with them, and you have the knowledge. And it helps you in your trading too. When you're evaluating the company, if they're a manufacturing company, you can go look and say, okay, what's happening with them? Are they a service company? So anyway, that's why I go over those. Let's look at a little bit of company news. Okay, Micron Technologies had a bad week, following a forecast that signaled a squeeze from weak demand for personal computers and smartphones, overshadowing the solid lift from sales of AI-related chips. Honda and Nissan, again, the car industry seems to be kind of in a mess right now, are in talks to deepen ties, 2 people said on Wednesday, including a possible merger. The clearest sign yet of how Japan's once seemingly unbeatable auto industry is being reshaped by challenges from Tesla and Chinese rivals. The Container Store is preparing to file for bankruptcy in the coming weeks, following mounting losses and escalating liquidity woes, according to people with knowledge of the plans. As the end of September, the retailer had 103 stores across the U.S. and $229.8 million in long-term debt, according to the quarterly financial reports. Bitcoin had the same kind of week that stocks did, and I think it went from a high of 108, it went down to 92, and last time I looked, it was back to 97 or 98. So I call it the Powell effect, has no bounds. During the bottoms of Wednesdays and a little bit yesterday, the market wiped out over 1.1 billion in trader positions in 24 hours. Both long and short-term traders took losses, but long positions accounted for the bulk of the liquidation. A massive 1.03 billion came from longs, while shorts saw 155.02 million erased. The liquidation frenzy wasn't limited to 1 or 2 assets. Bitcoin and Ethereum took the hardest hits, but all coins were also slammed. Traders who ventured into leverage bets faced brutal reckoning, which I never would advise on leveraging your bets in anything in crypto. As market suddenly swings triggered margin calls and automatic sell-offs, which are never a fun thing. I had to go through that when I was in the business during the great financial crisis. However, Bitcoin's value has gone up, from 65,000 since November up to where it's at now in 97,000. So it's still fewer in it. You're still in it pretty good. And it caught the attention of high-end fashion brands and retailers, prompting further interest in offering cryptocurrencies as a mean of payment to tap into fresh pockets of wealth and build loyalty with crypto investors. Australia's largest super fund, AMP, invested 27 million of its portfolio in Bitcoin, making it the first major fund to venture into the cryptocurrency market. Despite the risk, the fund had taken the plunge, said Stephen Flagg, senior portfolio manager at AMP. According to him, the cryptocurrency was simply too big to ignore in terms of growth and potential. Hut 8 Mining, one of North America's largest Bitcoin miners, has surpassed 1 billion in Bitcoin holdings following a $100 million acquisition of 990 Bitcoin. With the purchase, the company's total holdings have grown to 10,096 Bitcoin at an average cost of 24,484 per Bitcoin. These holdings, a mix of mined and purchased Bitcoin, underline Hut 8's commitment to using Bitcoin as a strategic reserve. CEO Asher Knut highlighted the importance of the company's Bitcoin reserve strategy. As we scale operations and extend our cost advantage in Bitcoin production, we anticipate that the flywheel effect will enable us to grow our holdings organically at a significant discount to market prices. So we're still seeing a lot of companies now switching to Bitcoin strategies. I think I just saw that Ohio now has legislation to look into starting a Bitcoin reserve. There's more talk in Washington about Bitcoin reserves. So we're seeing it with, we talked about it a little bit on our Bitcoin Zoom call, but we're seeing it in ETFs. We're just seeing the demand go up. And again, there's only 21 million Bitcoin, and it's a supply and demand issue. And we've talked about it, potentially including it in your portfolio as a small portion, as a commodity, as Bitcoin becomes more accepted within the investment community. Okay, PIMCO. When we go back to talking about debts, deficits. PIMCO significantly ramped up a market backlash against soaring U.S. debt by announcing plans to reduce exposure to long-term treasuries. And we've been seeing that Japan and China and other countries are not buying our treasuries anymore. PIMCO said it's reducing exposure to long-term U.S. bonds amid concerns about soaring federal deficits and debt. Instead, it favors shorter-term bonds, some overseas issuers, and corporate debt. The move represents a major escalation in financial markets over massive budget deficits and federal debt, which recently hit 36 trillion. Okay, so again, if our debt and our treasuries are seen as a lesser of an asset because of the ability to pay that back, because our debts are getting larger, more and more companies and countries and individuals are going to go look for value somewhere else, and whether that's in real estate or it's in art or it's in cars or it's in crypto, that's where they're going to go. And we'll see what happens. But again, we've been talking about debt and deficits on this channel since I've been on it, and it is an issue. And I hope that our representatives that we send to Washington can get that fixed, because you and I can't spend like they spend with limited income and live very long, at least outside of bars. And I'm not talking about bars where you get drinks. I'm talking about bars where you don't. So it's not just us. We're probably the best wrinkly shirt in the closet when it comes to that, because England's in a mess right now. The Bank of England left its benchmark bank rate steady at 4.75% during its December meeting, in line with market expectations, as CPI inflation, wage growth, and some indicators of inflation expectations had risen, adding to the risk of inflation persistence. So it's interesting that sounds exactly like what we just heard Wednesday, except we were still cutting rates. And so again, as a free-thinking person, you go, if the economy is so great, and if inflation's under control, why do you need to cut rates, is what I would be thinking, because rate cuts are used, to stimulate the economy. Stimulate the economy creates inflation. So I think, again, that's what the market saw. That's what I saw. and it wasn't explained very well. France. Uh, France ratings agency Moody's downgraded France's credit rating Saturday to A3 with a stable outlook following months of political crisis and the appointment of centrist Francois Bayrou as prime minister. The decision to downgrade France's ratings to AA3 reflects our view that France's public finances will be substantially weakened by the country's political fragmentation, which for foreseeable future will constrain the scope and magnitude of measures that could narrow large deficits, the rating agency said. In a highly political fragmented environment, there is now a very low probability that the next government will sustainably reduce the size of fiscal deficits beyond next year, as Moody said. So again, we're not the only country facing this right now, but we do have an advantage that we are the reserve currency still, and that we can still print money, and that a majority of our global trade is traded in dollars. Then you look at what's happening in Canada. Now, Canada's having an issue too, and we'll see if Trudeau can make it through. Look at Germany. Germany just had a vote of no confidence, so that Germany and France, the number one and two economies in Europe, is hurting. And then on top of that, you got China, which is really hurting, and they're talking about stimulus to get their economy going. So, I just have to go back to the market is not the economy. We're seeing markets at all-time highs here, and you're even seeing sometimes in Germany. So they're blind to actually what's going on. But when it comes down to it, debt and deficit, not only for us, not only for other countries, but for us as individuals. You look at individuals in our country and how much debt they're in, and credit card debt, housing debt, getting underwater in their car loans. This all at some point will come to roost, and at some point it will reflect in the stock market. And I think when you see the panic that we saw Wednesday, it's almost like everyone just has their finger on the trigger, waiting for something to happen. And when it does, they get out, and then all of a sudden, like today, okay, we can move back in. But it's almost like a dry run for for what could happen. But and again, that's why I look at these things, so that I just don't listen to Steve Leisman and everything is rosy. I mean, even Larry Fink of BlackRock said record government deficits and tighter bank lending means people, companies, and countries will increasingly turn to markets to finance their retirements, their business, and their economies, he said in a Q3 earnings call. Social Security is a fantastic foundation for retirement, Fink said, but if that's all you have when you retire, you're going to be living below the poverty line. It's supplemental, but it's not meant to be the totality of what you have in retirement. The current average monthly benefit retirees is $1,907, or just under $23,000 a year, according to Social Security Administration. The shortfall, more than $57,000. The maximum benefit for an individual retiring at age 70 in 2024 is $4,873 per month, or $58,476 a year. So again, that's why we talk about, when we look at asset classes and we look at monetary inflation at 13.3%, along with consumer inflation, you basically have to make over 13% a year to actually make any money. Otherwise, you're losing money through devaluation of your accounts and your dollar. So it's tougher to do that. That's why we've looked into the Bitcoin. That's why you look at the Mag 7. Those have exceeded that 13% over the years. You've got some bigger, like SPY equals it. So it's tougher and tougher for us to make money. Swing trading, if you can do it right, it was another way you can beat that 13%. And I'll go over a little bit of what we've done this year. But again, that's the macro that I see. Trent, before I move on to looking at a chart or two, do you have anything?
Yeah.
Anyone else want to talk?
Yeah. So I want to show, we used to talk about the yield curve a lot.
Correct.
It's interesting what has happened in the last basically 2 days. So this gives you a view of where the yield curve is. So right here is Wednesday the 18th. The yield curve was at 0.15. The next day, Thursday, yield curve's at 0.25. The yield curve indicates oftentimes recession or a growing recession, and the actions or the lack of confidence that uh, Chairman Powell had on Wednesday about what they were doing. And I think that translated into a the bond market saying we don't have any confidence that you can lead. You know what's happening today, but you don't know what's going to happen in the near future. And so this is the yield curve. This jump is pretty substantial. If I go back and I just hit a weekly chart and I go back in history, bear with me here. This is March of 2020. This is the peak in the week of March 15th, 2021. You know, we're in the throes of the pandemic, all that. Market takes back off, back down in this range, 2003. We're now moving back into recession territory. We're not in a deep recession like we saw during the pandemic, but the move is higher. And I think that, to me, you know, his language on his Wednesday call or conference call, to me, was, this is a man who thought they had it figured out, and they've been using indicators that they've used forever, and now you're in a situation where this is not working. This is not working. Our numbers aren't matching up, and the bond market is turning around and going, "Hey, we don't like that." Let me see if I can pull up the 10-year. Yeah, so this is the 10-year Treasury, and if I go back to, what was it, Wednesday? So this is Tuesday. 2.84% move in the 10-year Treasury yield. That's like 1,000 points on the Dow, losing 1,000 points on the Dow. That's that's the comparison in how significant that move in yields was. And the next day we were down, the yields were up 1.02%. So you're over you're over what, 3.86% move in 2 days in 10-year US Treasury yields. Now it's backed off a little bit today. It's at 4.506.
So Trent, is that
But
is
I
that a
think
chart of the actual price of the bond, or the chart only shows the actual yield of the bond
it's the
return?
yield. Yeah, it's the yield. So if you were on a trading desk, or if you were trading the bonds, you would price your bonds on based on the yield.
And
So if you
then, I
wanted to
mean, when
put
you
a
say they
limit order,
reacted negatively with the bonds and the yields, did that mean the prices of that they were willing to pay for the bonds also went down, or they went up?
the bond, so it's a teeter totter. Imagine you and
Right,
your buddy
right.
are on the, yeah. So when yields go up, values go down. So you can imagine how many retirees hold probably 60+% of their holdings in bonds, mortgage, mortgage-backed securities, US Treasuries, or corporate bonds. What this effect is on their portfolios. And we talk about Bitcoin, and as you were talking, Mark, I was like thinking to myself, are we seeing a shift in confidence on a global scale from US Treasuries as a benchmark, as a foundation of your portfolio, or corporate bonds as a foundation of your portfolio, to a we got to go somewhere else kind of thinking? And I'm wondering if this shift to Bitcoin from from countries all over the world, corporations, states in the United States, adopting an asset that is this a looking for an opportunity or a place for safety and security, and is Bitcoin, or a version of Bitcoin, the future? And I'm in looking at yields on bonds and where things are at, and then the confidence level that we're seeing out of Jerome Powell. I wonder, are we seeing a global shift? Are we seeing a global shift happening? Not a currency shift, but where do I park my assets for a secure standpoint? And I
I,
wonder if we're in the middle of that, in the beginnings
oh,
of that.
I know me personally, I am. Okay, I looked at it, as and being a skeptic, we've gone through all of it, and I've gone through the skeptic and the denier and all that, and now I do believe that it is a legitimate asset class. Larry Fink believes that. Donald Trump believes that. J.P. Morgan and and their CEO believes that. You're seeing just about everybody but Warren Buffett now. And Warren's always last. Okay, he was the last to buy Apple. He was the last, to do anything. Um, he's more conservative in his investments than I ever will be. But um, I do see that, and as the more people learn about it, the more they get comfortable with it, and you're seeing big swings. But you see when the price gets to 100,000, if it goes down $3,000, that's 3%. Okay, just like when you look at you know the stock market now, it went down 1,100 points. Well, back in 1987, 1,100 points would have been almost the whole market. And so again, as they've inflated, uh, the swings can be big, but the percentage wise are not that big. But I do believe myself that it certainly has a position when you look at what BlackRock did this week and advised their clients to have 2-3% of their portfolio into Bitcoin. And then the guy who was a CEO of TradeStation said the same thing. And they allowed their customers, which I don't know how you allow your customers, they should be able to do what they want, up to 10% of their portfolio into Bitcoin or crypto. But anyway, yeah, I think so. I think it's a new asset class, and I think it's one people are. I think it's still young. I mean, it's $2 billion out of 990 trillion, or $2 trillion out of 990 trillion. It has room to grow.
Yeah.
So
Well, and like we pointed out on our Wednesday video that we posted about the market cap in comparison, the bond market is 660 trillion dollars. The equity market, if I forget what the exact number is, but I think it was like 200-300 trillion
yeah,
or something like that.
yeah, yeah.
And then
I can find it
Bitcoin's
real quick. But,
2.1, or Bitcoin is 2.1 trillion. So the adoption phase, the population shift, or population's thinking on security shift, it definitely can be considered one of those assets that just it could be, the future replacement for, not replacement, but an alternative. Does that make sense?
yeah,
And I think people are starting to look at what's happening economically and going, okay, we're going to make this shift. We're going to start dipping our toes into it.
that's what you're talking about right now, as far as all the
Yeah.
asset classes and what money's in total value right now, 900 trillion. Bitcoin is right around 2 trillion. So
Mhm.
again, it is growing. We've seen it grow. But again, yeah, if this even just doubles or triples, you're going to see probably go up.
Yeah.
So,
And the key to all that is that you get large institutional money coming behind it, you know, um, just as you see with, real estate bonds and equities as well.
yep.
So
I'm not
interesting.
seeing the derivatives market on there. I know that's another few trillion in if you count futures and options and those types of contracts.
That
Eric,
I don't know if that's
I've thought
included in it or not.
Oh, okay.
I've actually thought about that because if you include the derivatives market, I believe it is the biggest market. Um,
Biggest turnover for
but
sure
it is,
on a
but
daily weekly.
it's a declining or a deteriorating asset. So it has a time frame. So I wonder if they don't include that when they look at this. Does that make sense?
Yeah,
So I mean, you
It
have a
definitely
futures
does.
contract, it's got a month on it.
It's not it wouldn't be considered like a hard asset that can be held for a long time like these can. So
Yeah.
yeah, probably most of the whatever it would contribute would just be in turnover anyway. So that's probably why it's not on there.
Yeah. Yeah. Huh. Interesting.
I'm having trouble getting this off the screen. I might have to close out and get right back on. So
Hold on, let me see if I can do it. There you go.
did you get it off?
Yeah, I took you off. Sorry.
Well,
You
it
have been
still shows
denied.
on mine. Huh. Okay.
Yeah, cool.
I got a question for you guys. Right now, we obviously we got a debt problem, and our government is indecisive and how to start tackling it. But we got something even more elementary. We have a continuing resolution. I think it's a CR. This is where they're voting on paying short term. I'm not sure. Maybe it's out to February, March. And it looks like the government might close down as of tomorrow morning. I don't see how these guys are going to agree. Uh, doesn't this really have we've gone through where the government shut down, the world didn't collapse. What's your feelings on it?
I think that initially most of America sort of brushes it off because they'll come to some agreement. I think where it becomes, I look at it and I go, it's a pain. People do things because of pain, or joy. In this case, if they shut the government down on Saturday, well, most people who work for the government don't work on Saturdays, Sundays anyways, except for park rangers and park, kind of thing. And maybe they get a little nervous, right? But I think where it becomes a real big issue and escalates and the American people start paying attention is when all of a sudden it's Christmas day after Christmas and you don't have a job, you're not getting paid. And then you get closer to the weekend or after the first of the year and then all of a sudden you don't get paid, then I think you see people coming unglued. But I suspect that something, they'll, Saturday or Monday morning, they'll come out and like, oh, we really worked hard, we really negotiated hard over the weekend. Excuse me, sorry, is that bourbon on your breath? Oh, no, no, yeah, it's all good. We're all celebrating. That's what
Government
I see
workers,
happening.
government workers are used to this, and they always get paid in the end. They always get their paycheck. They get paid. So it might be, 2 weeks or a month, but they never lose money, unlike a company shutting down or furloughing, where you don't get it. But anyway,
I think
I
it's
want to do
important.
a little look at that. Go ahead. I was going to look at
I
this
just want
week.
to say this, Mark, you brought this up, and I don't understand why American people don't take this seriously. Taking a look at the buyers of treasuries, and you're saying China is basically sort of saying, hey, we're not only not going to buy, we're going to dump your debt. And there's other parties out there doing the same thing. Hey, if there's nobody at the window willing to buy, how are you going to finance this monster?
If you go
Yeah.
look at the treasury markets and in the auctions, you're seeing more that the Fed makes banks buy these things. If they, they'll make them, and then there's
Yeah.
dealers that have to buy whatever's left up. So somebody has to buy them, you know. But it's almost like we're paying dealers to buy them for us. It's
Right.
actually a form of a Ponzi scheme in my mind.
Yeah, I think you're right on. I'm sorry,
Yeah,
I won't say anymore.
yeah.
No,
So
no, I think it's interesting just with what happened with this bill, this 1,500-page bill, and how because of one guy getting on his platform and screaming about it and starting to point out exactly what's in it, all of a sudden everybody becomes aware of it. I was in my chiropractor today trying to get my shoulder back in line, and and he's definitely on more of the Democrat side of things. And he asked me, "What do you think of the market?" And I was like, "Well, and I'm trying to be not, scoot around it. And I just said, we just have to change our behavior here. I'm like, Rob, if you had make 100K and every month you borrow $10,000 and your income's not going up, it's actually declining. Do you think that's okay? And he's like, hell no, it's not okay. I'm like, that's what we're doing. And he's like, this has got to change. I was like, well, and he brought up the whole Elon and the bill. And he was like, this is ridiculous. Why does Washington need a new stadium? Why do they need a raise? He looks at me, he goes, I got one kid. Christmas is expensive.
Mhm.
I need a raise. Give me a raise.
But I think more and more regular people like us see that, and I think that's what probably happened in the last vote, and we'll see what happens. But it takes a lot. These guys get entrenched there in Washington, and they get on the dole of these lobbyists and these industries, and they're in their pocket, and it's hard to they buy them out, and they don't represent us, they represent them. And for too many years it didn't hurt us all that much. We lived our lives, and we went on vacation, but now it started to hurt because of this inflation, because we're borrowing so much, uh, and the inflation rate went up, and then with borrowing so much, they devalued our dollar, so now it costs more to buy things. And like you said, Trent, we're not getting any more. We're not getting any pay raises, especially those who are on fixed incomes. The older people, and it's hurting. It's hurting the majority of the people I deal with here in the Midwest, and they're pretty conservative in their values and in their economics. And I hear business owners, small business owners, talk about the same thing. But if you go and you listen to, the guys on the financial channels who have multi-million-dollar contracts, they don't matter if their milk went doubled or their eggs are $8. They don't even know it, because it doesn't affect them, but it does affect the majority of the country, and that's what we're seeing. So I want to look at some charts and things, and I want to look at what happened this week, and I kind of saw this coming, and I think we all have for a while, and we talked about it either last week or the week before. The markets were going up, hitting all-time highs, but what was hitting all-time highs was really moving back into the Mag 7, okay? Because we went and we looked at charts, and I showed them on the Discord, and Paul brought up the ETF mags, which showed a good part of it, that the mags are going up, but if you look at the equal weight, S&P, it's going down. So 6 of the 7 mega cap tech giants, and this was last Friday, hit record highs, with the group's combined market cap reaching 17.3 trillion. And Nvidia last Friday was the sole exception. So I wrote this week, and this was last Friday, looking at the daily charts as we do as swing traders, we are seeing many of these high flying mega techs are experiencing resistance at their intermediate resistance level. I'm also seeing many of these charts of major indices such as SPY, and the DIA, and the Russell 2000. The DIA has already hit the IRL last week, in 2 weeks, and price action was trending down. Well, why was price action trending down in the DIA and not the SPY or the Qs? Well, because they don't have the Mag 7s in them. And again, so for this week in swing trading, I only put really two companies. I think it was Palantir and DJT on the watch list for swing trading, and I was very leery about when we talk about known market conditions and unknown market conditions and how it affects swing trading. Known market conditions are like we know an earnings report's coming up, okay, which is why in my trading I will exit a swing trade before an earnings report if I remember to look and find it. Sometimes Paul has to remind me, hey, there's earnings on there. Like, oh crap, and we've all forgotten them at one time or another. But earnings can go up, and it seems like earnings now, if it comes out, and guidance is good, it goes up 15%. If it sucks, it goes down, and you don't want that in a swing trade. So I just get out if I have a profit and get out. That's a known market condition. An unknown market condition is when you keep a position over the weekend and it's looking good on the chart, and then Sunday night Smithers and company comes out and they an analyst, and they torch your stock, and like we're going to short this thing. And you're like, crap, I just bought into it Monday morning before the market even opens. Your stock is down, you know. So that's an unknown market condition, which you really can't help. Okay. And you hate it when it happens. But sometimes those unknown market conditions can help you, as if you have XYZ drug stock and over the weekend they come out and Merck bought your stock and you're going to pay you $50 a share and you bought it at 10. Okay. So that can help too, but we don't know they're coming. So this week, the known market condition was this FOMC meeting. And I was talking to Trent yesterday, and FOMC meetings used to be no one cared. No one even cared what the Fed said. I mean, no one even showed up. You know, you'd have 3 reporters. And now we look at them like rock stars and like, oh, are they going to do a quarter point or not? What are they going to say? Where's the dot plot? Did they change a period to a comma? I mean, they look at it and they're like, I don't really care, but it does affect the market. And we saw that this week. So I have put like FOMC meetings, you know, when they're doing rate cuts on my list of known market conditions where I don't even like being in it. And I said Monday and Tuesday, well, after Monday, when I had the 2 positions, I said, I'm not going to, you know, enter anymore. But so Tuesday morning, you know, I said after we had DJT and Palantir, there's no need to enter new positions until after the FOMC decision, which I wrote and I believe. Then Tuesday afternoon, DJT price action, it hit my upper Bollinger Band, which is one place I'll get out, or the resistance level. It hit a sell order at resistance, providing the paper trade portfolio with a 6% gain or 222 a share. And I wrote, I could have stayed in per my indicators. All my indicators look good on Donald J. Trump. You know, I could have stayed in. But I knew, and I wrote this, I knew there'd be an FOMC press conference the next day. So I wanted to take the gains and enjoy the day. So on Wednesday morning, when we were looking at, you know, the watch list of charts of interest, and this was before the FOMC announcement or the market even opened, I wrote that the DIA is priced down over the past 8 days. That's the Dow Jones ETF. And the SPY, which is the S&P ETF, is trading sideways along the IRL. The Qs are showing rising price action, mainly due to the momentum of the Mag 7s, Google, Microsoft, Apple, and Tesla. Note there is no IRL on those charts, shown on those charts, and many show price action trading outside their Bollinger Bands. The exception is NVIDIA, which is trending down. Okay, so I said that before market open. Again, I don't like trading stocks that don't have a known resistance level. And I don't like trading stocks outside the Bollinger Bands. So then we had that press conference. Okay, and the markets tanked. And so Thursday morning, we started out and the markets in the pre-market were up. And a lot of times you'll see a bounce after a big, long drop. And it'll come back up and then it'll come back down and it'll either reconfirm or go back up. So I wrote in the pre-market, I said the futures were up this morning and markets opened in the green, with the 3 major averages gaining about 0.5%, recovering some ground after a sharp sell-off of nearly 3% the previous day, driven by the Fed's hawkish outlook for 2025. And then I wrote, I'm assuming the retail investor will immediately turn to the buy the dip mentality today. Technically savvy swing traders will be patient and wait for the charts to provide us with signals as to when we should re-enter positions. Okay, so what I'm trying to say is, just because of, you know, it goes down does not make it, in a swing trading technical analysis point of view, a good time to get in. Still use the charts. The charts will tell you when it's ready to come back, when it's ready to come back in, if you're swing trading. Okay. And when markets go up like they do yesterday, I don't like the dollar cost average when you're going up. Okay, because I'm raising my cost basis every time I buy going up. If I have a position that I like and I want to build a position even more, I wait till the market goes down like Wednesday, if I like it, and buy it on the way down because my cost basis gets lower on each lot that I buy. So again, so, you know, so what happened Thursday? Well, the upward price action drew in the retail buyer, buy the dip people in the morning, because retail investors trade in the morning and industrial guys come in the afternoon. Then only to be rug pulled by the end of the day. The S&P and the NASDAQ closed 0.1% and 0.5 lower. The Dow just was up 14 points. Okay, so it did snap a 10 session losing streak, but it did. So you might have been, you know, if you didn't use your charts or you didn't have the knowledge, a lot of the retail investors got rug pulled yesterday. Of course, today the markets are up unless they panicked and got out. So this is the way the market can take our money away from us. And it takes a catalyst when you're running equal. And let me put up a chart here. And hopefully this works. Okay. So like here's the Dow. This is the DIA. It's the ETF for the Dow Jones. And here's your intermediate resistance level. And for 10 days, almost 2 weeks of trading, we were sideways and the market didn't know what to do. But at that time, you started seeing some window dressing, and the money was flowing into exclusively the Mag 7s. Well, the Dow doesn't have any. And so we start to see the Dow is sinking down below, and it went along the 9, underneath the 9, and continued down below the 50. And now we've come down, and today we've come back up, but we've come back up to where the sell orders are. If you look at the oscillators, we have a little bit of a tick up, over on the stochastic, and a little bit of a rise in the RSI, still not 50, and no crossover yet on the MACD. So again, this is something, if you would have been in here, you have a trading plan like mine says, get out when it hits the IRL. I would have gotten out and I would have missed this down trend here. Okay, I wasn't in the DIA, but that's how having a trading plan, you affect, if I look at something and I'm like, do I want to get in? Do I want to get out? I use my trading plan. So even today, would have gotten out up here, wherever that is, 448. Today we're sitting at 430. We got smoked on Wednesday, 424. But again, would I get back in on this because it's an up day? No, because look, there's sell orders right here. We talked about the Qs. Now the Qs is different. Okay, so we were going up. You're seeing money go into the Mag 7. And we actually, we passed over this line of resistance was actually up higher. It moved down once these lines will recalculate. But we came up, and this one here, this is where the sell orders were, and it hit where the sell orders were. And then, of course, boom, we hit. There's our Wednesday, and now we've come back, but we're still under the 9. This one shows even more deepening. We saw the Dow we had a crossover at a lower level, the stochastic. We've got an RSI that's above 50 now in the Qs, but we still don't have a crossover the MACDs. So again, I'm leery of this line. I wouldn't personally get into the Qs yet. I don't even have a confirmation on the MACD. But again, we were rising up. Look at the SPY. This has all the Mag 7 or the Mag 7 in them, the SPYs. Same thing on the S&P. We saw sideways. There was no catalyst to move this up. And the catalyst was, that the FOMC meeting could have been a catalyst. If he had said, for example, we're going to lower rates every month next year. And this would have been the opposite direction, I bet. And that would have been the catalyst to move us past these resistance levels and these Bollinger Bands, but he didn't. So now we came down, we were underneath the 50. We're still having some trouble getting past that 50. We did wick up to where the sell orders are. Still no confirmation down, in our oscillators. So again, had you been in this and hit up here, you would have been out at this level. You would have sat out the sideways movement, okay, until the charts told you to get back in, and which they haven't yet. Let's look at the small cap. Oh, this was just this used to be where the green line of resistance was right here. And since this big move down, it recalculated down. You can see what happened. And now it's having trouble just even getting past that. The small caps got hit hard. They rely on cheap interest rates because a lot of the 40–50% of the Russell, they don't make money. They have to finance their companies. And as debt comes due, like we're seeing, and I forget how many trillion in commercial real estate, if the interest rates aren't down, we're going to see a lot of heartache in commercial real estate and in small business. Sector wise, all last week I put a lot of these charts up. Same thing, just cruising along, hit resistance, dropped on Wednesday, still below the 200. Okay. Again, if you were riding this train up, you would have hit that, get out. Okay. Those are my trading guidelines. You all have your own trading guidelines, but you'd still be out. Even though today, the buy the dippers, maybe they get back in. If you're a swing trader with my trading plan, I'm not getting back in. I don't see anything here that looks good yet for me to get back in. That's the communication sector. XLY. Okay, same thing. Hit resistance, came up, sell orders, Wednesday, sideways. Okay. Oscillators don't look good here either. So there's two segments that are underneath, the 9 and playing around with the 20. XLP. XLP, this is consumer staples. You can see we came up and it started going down even before Black Wednesday or whatever they're going to call it. But we were under the 50. We were driving down to the 200. We're seeing a bit of a turnaround here on the stochastic. We still need to see if the MACD will come by. But this basically just came back up to the Bollinger Band, the lower Bollinger Band, which is two sigmas from the 20. Okay, so again, this may just ride the Bollinger Band down. If it does, we'll see support at the 200. But again, here's another one that's third sector that's not looking too good right now. XLE, energy sector. That's energy sector's just been horrible. Okay, and it's again, you come up, we're above, we got above, we raced above. This IRL was up at this level here, and it moved back down, got below the 9. Now we're below the 50. We're actually below the 200. So energy is technically from a technical standpoint, energy is now in a bear market when you look at it technically. But what happened is it come down and it hit the intermediate support level. And we'll see if it can hold here. And this is a pretty good support level, just like this is a good resistance level. And we'll see if it can come back and energy comes back. So this is one you'll watch for on a swing trade, potentially as a setup. It's not there yet. And once this starts turning, and you can either try to get back into this sector, or you can go within the sector and look at ExxonMobil, look at Chevron, look at any of these, Schlumberger or whatever, and see what's making this market move. And that's where you find your swing trades. Right now, this isn't it yet, but I'm encouraged that it's holding on this support level right here. So energy's down. Financials. Again, financials came down. Boom, we're under the 50. 3 days under the 50. Got converging moving averages. A little bit more momentum. We're seeing some pickups. Still no confirmation on financials. Again, below the 9, below the 50. Looks like a less of a glide path down than we saw in energy. But again, not something I would get into at this moment. XLV. So when I go through all these, you can see why the watch list sometimes gets a little bare, because there just aren't the setups. I mean, the setups are like right here. Okay. But again, this is a healthcare. It's below the 200, technically in a bear market. Okay. And we're riding the Bollinger Band down, hit the support level, went below it yesterday, and then came back up a little bit. Seeing some bumps here, nothing yet that I'm excited about. But here's another one that could go on under the 200 list if we can get above that 9 and start heading back up. We'll see. It's not there yet. XLI. Industrials. It's coming down, following the lower Bollinger. It's been off for a while. Again, nothing that I see, potential, but it'd be on a list to watch. We'll see if it comes down and touches on the 200 or not. It's still in a bullish technical pattern until it hits that 200. XLU. A lot of times you'll see utilities come back up when interest rates are lower. It was Wednesday. We had 2 days up so far. Again, we'll watch this one. If it can get past that 9. We're seeing some positives down here. We still don't have confirmation on the MACD. This is pretty important to me, that the MACD cross can give you confirmation. And it can come close sometimes, or you can use the stochastic and say, okay, it crossed. I think it's going to happen. And a lot of times, majority of times it will, but sometimes it doesn't. And then you get a little burn. XLB. Material sector just got hammered. Okay, it's still following the Bollinger Band down. Update today, we'll see what happens, but nothing that I see at this point. Luckily we have a support level down here. We'll see what happens. Again, another sector not looking good. Real estate got under the 200. Look, it came down, couldn't get back up yesterday. Today it's trying to get above the 200. We'll see if the momentum will push it up. We're at 32 on the RSI. We'll see. Real estate relies on lower interest rates, so it got hammered pretty good. But again, here's another sector that's trending along a bearish look. And then technology, XLK. Okay, green line of resistance here. Still trying to have trouble here. We're going sideways with the Bollingers. Oscillators don't look good. Okay, so technology is probably a few stocks. The higher, the bigger weight stocks are probably pushing this up today. And we can go look at those. We got Apple. See what Apple's doing today. Now, see Apple's right back. Really didn't get hammered too much on Wednesday. Went down to the 9. Still following right along this resistance level, topping up to where the sells are. The sells are around running with the Bollinger Band. Okay, so converging Bollinger Bands. We'll see what happens. A little bit of a crossover on the stochastic, but Apple is holding there, but it's having trouble. It needs a catalyst to get past resistance. Meta. And you can see why the markets went down. These are the big dogs that run the big indices. And again, Meta came up, played along the resistance level, boom, Wednesday, and now we're playing between the 20 and the 50. Again, the oscillators don't look good on Meta either. Microsoft. Again, we said if these came down, it's going to take the market down, and this was a pretty big drop on Wednesday. Came up 4 days on the intermediate resistance level. Got kind of a top here, the spinning top. We wicked up, we wicked down. We're still right at the 20, so we're hanging around the 20. Again, oscillators don't look good on Microsoft, even though today it looks good, But we have to look out at the charts and see what they tell us. Tesla, this has been hot. Again, right along its resistance level, came up here, hits the sell orders a couple times. But again, playing around the 9, when all these things kind of converge, you've got just a lot of pressure. It's going to take a catalyst to move it up or down. But again, I'm looking at a MACD coming down, looking at a stochastic coming down. Is this something that would give me confidence to hop into? Not from a technical standpoint. I wouldn't. Maybe on a fundamental, but I don't do fundamentals. So again, Google came up. Here's your resistance level, played along with it. Wednesday came, dropped below the 9. Today we dropped down a little bit too. We're still playing right at the 9. We'll see what happens. We haven't crossed on the MACD yet, but we did on the stochastic. So we'll see what happens with Google. Again, I wouldn't get anything that I would want to get in because I'm not above the 9, and this line here it makes me want to get out. But the one thing that I've noticed is that if you have the sell level orders up above your resistance level, if it can get past there, they normally come up close to touching before they come back down. So, keep that in mind. It's just an observation. It's not something I tested out. Netflix. Yeah, I'm just going through the Mag 7 so you can see. Netflix was kind of like Apple, just kind of, it did drop down a little. I mean, it's under the 9, we come back up with the 9, the sell level. See, here's where the sells are below the resistance level. Again, it's going to be hard. You got converging sideways pattern, but I got oscillators going down. So for me, and that this isn't something I'd be interested in just from a risk reward standpoint. NVIDIA. Oh, NVIDIA again. You got your 50 and your resistance level right next to each other. Then you got your sell orders, you got your 20, and I mean this is just really tight. So we're below on the MACD. Go ahead.
Something to point out, Mark, is if you go back to like its peak, just on the edge of your yellow box here on the left,
well,
it's
that,
just
that
trending
used to
downward.
that used to be where
It's
the
just-
resistance level was.
Yeah, right. But it is over since then. It's trended downward.
Yeah, and
So
that's why the
until that
resistance.
trend,
Yeah.
Yeah, and so that trend, as long as it's continuing to trend downward, it's most likely going to trend downward. So
Yeah.
why guess at it? You
Yeah.
know, why
I mean,
fight it?
yeah, it's risk and reward. And it comes back to the point that I say you don't have to be in the market all the time. And when I look at markets and I look at these charts and I look at thousands of them, and I see this and I see all the sectors doing what they're doing, and I see what's happening in the major, indices, and they're sideways and they're against resistance. And that's why I'm like, do I want to risk my money until I get a better setup? And a better setup would be what I've been watching, my old favorite, right here, Berkshire B. And I've been watching this. I've been telling people, watch. I mean, it's come down, blah, blah, blah. It's still above the 200. But look what I'm seeing. I'm seeing ticks up here. I'm starting to see a MACD that looks like it's going to come. And I'm seeing here, we're finally coming up. We need to get past that 9. Okay. But this is something that I'm watching for a setup. And would I buy right now? No. Okay. Now, my technicals don't tell me to buy. So, but it's on a list and I watch it. And when the market tells me to get in, that's when I'll get in. And then I'll hope to, I can get it to move. All right, I'm gonna have to do this. I'll hope to get in and find something like this and ride that up and then get out. And then we had sideways. Okay, and we've been playing with, here's another one, boom, ride it up, then you get out. So that's what I'm looking for with Berkshire. Is it there yet? Would I buy it on a swing trade? No, it's not telling me to do that yet. No, my chart's all screwed up. Oh well. So anyway, that's kind of my thoughts of how I think on swing trading. Okay, so it's hard unless you have a trading plan that you've developed and you follow and you like, and whatever plan you have is fine. I have mine there. I trade off of mine, and in the Discord, I compare everything you guys send me to my trading plan, because that's the one that's the standard for the channel. And then you guys have your own trading plans. Hopefully you have a trading plan. You're not just buying the dip because you think, a $40 stock is better than the $50 stock, when we just went through a bunch of charts that shows that it's probably not yet, unless the chart tells you. So the importance of being patient and not letting the psychology of the market pull you in just because the market went down and today's a good day. And today we're up. Well, the Dow's now at 620. It was 8 something when we started this meeting. So there's an opportunity or possibility that the Dow closes flat again. I mean, it really is with this market. Who knows? All the charts don't tell me it's going up. Okay. You see, all the oscillators are going down still, even with this big top. So again, that tells me that there could be another rug pull, and I'm not seeing the momentum, like Trent said, going up. I still see it going down, even though you have one day up. So just be careful. Use a trading plan. Go look at mine. You don't have to use it, but at least have something standard that you use, and don't guess. Okay, don't let your emotions take over your trading or your investments. And that's all I got to say. I think I'm out of words. You guys got anything to say? Paul,
Yes,
you got anything to say?
I do have something to say.
What do you got to say, Bob?
All right. Do you know what today is?
Today is Friday.
Yes, I understand that. And it's December 20th. But
Right.
That's not the answer that I'm looking for.
Okay,
We have triple witching going on.
that is true.
We have triple witching going on at the end of every quarter. When you take a look, and you obviously you steer away from things with earnings. I understand that makes perfect sense, dividends. But don't you think that also this triple witching is something else that should be on a person's calendar?
Absolutely. That's why I put it in this morning's news.
And by the way,
morning
maybe
news.
I didn't read your morning news, so that's why
What?
I'm asking a dumb
I get
question.
up at 4 a.m. every day to do that stuff, and you don't read my news?
No, that's not true. It just
Oh,
happened to
okay.
be I didn't read it
That-
this morning.
His morning hasn't started yet. He's
Oh,
still in
okay.
the evening. He's still
Oh,
is that
okay. All right.
And I'm on Eastern time, and you're on
Central.
Central.
So you're up. See, I'm up at 4. You've had coffee at 5 by then.
The thing of it is, I don't have any coffee.
Oh,
You know, I think that as big as the derivatives market has become, you have to pay attention to it. Especially, you know, I'm really interested to see how the day ends because it is really the end of the year if you really look at it from that, you
for
know,
me it
from
is.
the volume, the number of participants. And, you know, I know like I've been following the video all morning and I it's you know it hit a peak I think at the first around 9 o'clock central, and it's just now trending south. And I'm wondering, is this the unwinding of these option contracts and derivative contracts? And as we get closer to 3 o'clock central, is that going to accelerate? And are we going to see Nvidia end the day on a negative, which probably would pull everybody else in that group south as well? Um, yeah, I think that you have to pay to, especially 0 day expiration options that play the S&P and the Qs. I think you got to pay attention to that stuff because it's so big. It's such a big market. As Eric was pointing out, it's a become a behemoth in a sense.
Yeah,
So, and it changes very quickly. So,
definitely.
yeah.
Here's the mags that Paul brought up to us. This is the mag sevens, and you can see this lines up exactly what we saw in the Nasdaq and in the S&P, and then boom. You know, I still, you got a nice big candle getting you back up to the 9, which is now squeezing into the resistance level and the sell levels. There's not much for me personally to say I'm going to gain out of this chart right here. And then I look, well, maybe it's going, well, no, the oscillators tell me still, especially the stochastic, that we're not there, and also the MACD. So this won't drag me into it. Again, take your emotions out, look at your charts, see what your charts tell you, and say, look, I'll wait until I find another one of these on this chart, or another one of these on this chart. Just be patient. It's hard. It's hard to be patient. Holy craps, it's hard to be patient. But I became way more patient when I started making money as opposed to losing money, which is
Huh.
which is more fun to do.
Yeah.
Let's see here.
Hey, I've got a question for you, Mark. And I'll tell you, I think you introduced it to us about a month and a half ago, and I thought it was very interesting. I even went into it on 3 of them. That was Yield Max,
Yep.
and you just had Roundhill up there. Roundhill is a competitor to Yield Max. Is that correct?
I am not familiar with Roundhill.
Oh,
Do they do options, call
well,
options?
you just said Roundhill Mag something. Was
Oh no,
Mag?
that was the mags.
All
That was an
right.
ETF.
But
That was an ETF.
tell me, have you ventured into any competitors to Yield Max?
No.
All right.
And you got to be careful with those options, call options, because if the underlying uh, stock goes down, those options will go down too. But and their dividend, their payout will be less. So you just got to be mindful. There's principal gains, which is the principal of the stock of that ETF, and
Mm-hmm.
then there's yield that it gives out monthly. And you got to balance those out. You can get your yield, but your principal may go down below what you're gaining. So just be aware of that. You know,
Have you encountered any problems that way? That the principal went down
yeah,
and that you actually were less because your payout was less?
yeah, yeah. I mean, but you got to look at it. I have an option income strategy. I have 4 of them in there. I think I've showed it before. And you buy 100 shares of each. I think it cost me $8,000, and it's been up and down. But you can track how much you make, and like MSTY has been paying. Well, the last 3 months it paid 420, 422, and I think 3 something this last month.
Mhm.
So you have 100 shares. That's 4, 8, $1,200 right there. So and then you count, you base that off, okay, how much did that go down? You know, uh, and it's up to you how you do it. If you just want to leave it in there, but it can go down if they don't run it right, and you may want to include it in a strategy that you put it on your list and you watch it on a swing trade. If it goes below one of your support levels, you get out, and wait for it to come back. But that's just another strategy.
How long have you been in yield max?
Oh, several months,
Oh, several months.
Yeah, at least, yeah, this year. I mean, the guy who runs it, I used to work with down at Ameritrade, Jay Pestricelli. So he was always pretty good at all that, all the option stuff. So I'm gonna go over. This is our paper trade portfolio, which I'm ending the year today on this one because I'm not going to trade on this anymore because of we made 323 trades, and that's average of 6.46 a week. Okay. So you don't have to trade that much. And some weeks we didn't trade hardly at all. Divided by 12. And again, this was I was trying to get through the year without having really a loss on the week. And last week I did $31. So sorry. But for the most part, we did pretty well. Oh, there was one too. Okay. For the most part, if you follow trading guidelines, you'll have losses and then you adjust them. And then you get out. And so I would suggest if you're swing trading, you put together something like this so you can, at the end of the year or end of the week, end of the day, you can see what you're doing. And, we're looking at, 1%, 6%, -1%, 0.74%, 0.58%. Okay. But these add up on a daily and monthly and, weekly and monthly time frame, to the point if, again, we were putting $100 each, or we were paper trade $100 or 100 shares each of these. So some people can't afford some of these, but you can, if you do it right and you do it professionally and you don't let emotion get in, you're going to get caught on some things. But that's why we have stops. And I try to put a limit of no more than 2% loss on anything that I trade in, and that keeps me at 2, so that when I get fours, that makes up for those twos. Okay, here's 249, 298, 607. That just helps you in your head stay out of the emotional aspect of trading, and that's what kills most people, is the emotional aspect. And the second thing that kills most people is mixing up your trading account with your investment account, because they're two different mind frames. If you look at Kerry and what Kerry's doing in investing, he's looking at all the fundamentals and the numbers, and he says, I don't care about days like Wednesday, because on average it's going to go up, and I'm in it for the long term, and I see these great numbers in there, so I have a conviction in that. A trader looks at it and says, I'm not a guy that wants to be in it very long. I want to get in and get out. Okay. And I'm not going to take those swings down, And so as an investor and a trader, you got to put on a different hat, when you do that. And the way I do it is I just separated my accounts. I have an investment account, and I have trading accounts, and then I have one for income accounts. Okay. So that when I'm in it, I know what I'm doing and what I'm trading for. So I don't mess with the long term. I just mess with the trading account, and I'm not always in the trading account. 2 trades this week, big deal. So anyway, that's my message, for my Christmas message for the Platinum Channel is I appreciate you guys being with us all year. I can't believe it's 323 trades. Wow, that's a lot for me, but I know you guys have your own plans, and you participate in the Platinum and you participate in the live, which I recommend. Get in the live sometime and talk to these guys. It's fascinating. And I love your support. I love your questions. I hope everyone has a good holiday. We're not going to have a Zoom next week because it's Christmas week. And a lot of people are traveling and gone, and my schedule's full of Christmas joy. So I'm being facetious there, but we're full schedule. Uh, but I wish everyone has the best holiday, and we'll kick her back up next year too. But I'll put out some stuff this next week, and it's not like I'm going to go away, but I'm not going to be intense on trying to find a lot of stuff to trade, because it's just not. It's not going to be there. It's not worth it.
Thank
But
you,
you guys are
Mark and
free.
Trent.
You guys are free to do whatever you want, though. Go ahead, Bob.
Thank you, Bob. Thank you,
I
everybody.
want to thank both of you, and I wish you a Merry Christmas and a Happy New Year.
Yeah, thank you.
Yeah, thanks, guys.
You
Merry
as well.
Christmas.
Happy holidays. Yeah.
Yeah, I appreciate all you guys. And if you have questions or anything, you can always go to the Discord. Trent's got an office. I have an office, or get on to the Platinum chat. You know, I'm mostly on Platinum. Trent, he's on Gold and Silver quite a bit, and Platinum. And then once in a while we jump into live, you know, and we're going to continue next year to do more stuff. We're going to continue on the crypto trail, as we believe that's going to be a bigger asset class and a more chance for some gains. And Trent's going to work into more of the other coins, and I'll stick with the Bitcoin side. And we're going to start growing that way, and making sure we don't lose money, and hopefully we make money. That's all I got. My
That's the
voice is
goal.
gone.
Amen.
Yeah.
What's the first coin you're going to look into, Trent?
Where I've started to what I'm going to start is with market cap. I've got a spreadsheet using my price range projections, and I've started using market cap stocks because, like, I don't know a lot about some of the smaller ones. So maybe Eric, you can make some suggestions, and just shoot me
Yeah, I
a
mean, as
text
far
or
as I know,
something.
that market cap list of like altcoin or from Bitcoin down, whatever one has the next, like the top four are pretty much Ethereum and XRP, and I think
Yeah.
even like one of the stable coins like USDC or Tether is number 5. So any of
Yeah.
those, I mean, XRP is a big controversy right now because they just had their
Yeah.
RLUSD stablecoin come out, and a lot of people are saying it's got a lot of use cases for like what would be involved in the banking system. And XRP is also non-inflationary, kind of like Bitcoin, because every time a transaction is made, a little bit of XRP tokens actually get burned and aren't available anymore. So the price can only ever increase with the more the network gets used. So that would be my pick for the first one I'd want to learn more about. I've already been in Ethereum for a while too, and it's kind of a similar situation, except Ethereum, the main complaint has been that the fees on the network are way too high, even though it is
Yeah,
quicker
they're
than Bitcoin.
expensive.
But so XRP is coming fast, I think, for competition for
Yeah.
Ethereum.
I think the other part of it is giving people, like, applying what Mark has taught in swing trading and the techniques there as onto crypto, because I think there are people who want to buy it and hold it, and then there are people who want to trade it. And I own Bitcoin, I own Solano, I own Doge, as I'm holding it. But as you guys have seen, every so often I'll trade iBit, kind of thing. And it's because I like that. That's the other side of my personality, is I like trading stuff in a very short term, and I like making money in the short term like that. So I think by expanding that out, I also have plans to expand out our tracking of the more popular ETFs as well, because I know there are people who want longer hold or core portfolios. They don't necessarily want stocks. They want a basket, so an ETF approach, and creating some sort of program around that. So one of the things to look for as we get closer to the end of the year, if right after the first of the end of the year, is a survey, and basically asking what you guys want to see more of, and what you would like to see less of, and what would add value to y'all's life. So that's something I'm going to be working on over the holiday. And so look for an email on that, and please participate. It'd be great to get your responses. But really just really trying to narrow this down to exactly what you guys and everybody who's part of Platinum, and really Best of US investors, really looking for in streamlining things. So but I really appreciate all you have done. I was thinking about today about just where we've gone in 12 months, and the changes that have happened, the market, the conditions, Best of US in general. And I look at that and I like, wow, we've come a long way. Um, Now it's like, okay, how do we really fine tune this even more so? Because at the end of the day, and I think I've stated it in my office a couple weeks ago or a week ago, is I real I just want to make money. I want you all to make money so we can all go do fun stuff that we deem fun. At the end of the day, that's what money is for me. It's a fuel for me and my family, my people, the people I really care about. And you guys are in that group. I just want to see you go, hey, I won. And I was able to go, at 9:30 at night and take my daughter to Dairy Queen. That's to me, that's the shit you take home with you when you exit this earth. It's memories, it's not stuff. Unfortunately, I'm coming up on 10 years of my sister passing away. And that was an experience, and watching her move on to another world, to hopefully a better place. And there was no U-Hauls behind her as she was traveling. And I was one of the, and somebody asked me a couple weeks ago, why'd you get out of the financial planning industry? And I was like, after 50 people, 50 friends dying in 20 some years, I got tired of it. And it really just tells me more and more this, we should be seeking memories that we can take with us beyond this earth. We should be having fun, and this should be fun. Of course, you're gonna have stresses. Of course, you're gonna run into a wall every so often, but you got to smile and laugh and go, shit, I'm here. I'm doing this. Let's do it and have fun. And I honestly, doing this with you all and having the interaction with y'all has taken my life to a whole another level. And I just love y'all for it. So thanks. Before I start crying, for some reason, I
Looking
think
forward
it's
to 2025.
full moon or something. What's that?
Looking forward to 2025.
I am too. I'm
It's
super
gonna be
excited about
interesting.
it.
It's
So,
gonna be interesting.
Yeah, appreciate you guys. Really
Yeah, happy
do.
holidays.
Yeah,
all
you
right.
guys have a good week, and we'll be around. I'll be around this week, and then I'm heading to Missouri next for New Year's um, week. But I'll still have computers and stuff, and we can still talk, and everyone can continue on as you do.
Yep.
And just be careful. Have a plan and follow your plan. And if something goes wrong, analyze what went wrong, and change your plan, and keep improving it. And your chances and your probabilities of increasing your 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 trade performance, it just goes up. It's amazing. It's amazing. And you don't have to worry about emotions anymore. You look at it and say, no, that's not for me. I'm not chasing it, or time to get out. I'm not in love with that stock. Time to get out. The chart told me, and you get out, you know.
Cool. All right.
You know
Have
what?
a great
Your little
weekend.
your little rant reminded me of Deep Thoughts with Don Henley from Saturday Night Live. Deep Thoughts with Trent Grinkmeyer.
Oh, I have a lot of them. I, I I had a coach once who said, "You just need to quit doing this and become a motivational speaker." And I was like, "Really?" And I never rarely say anything, but at the end of the day, it's all about having a good time. It's about smiling and laughing. And I tell my daughter, I have to just share this. My daughter met a young man when she was 16. She's 5, 6 years now. She's 21. They both, Connor graduated from college in May, and he made the decision to join the U.S. Army. And because he had a degree in HR, and he was like, where am I going to go with this? And he had some buddies who went into the IT side of the Army. And Connor decided to do the same thing. And so he's in cybersecurity. He got through boot camp. He went to boot camp in July. He's been in AIT, which is the 36 weeks of training. We haven't seen him. My daughter has to go pick him up because of dynamics in his family situation. My daughter's drove up to Augusta, Georgia to pick him up. For 3 weeks, she's been home from school and she's nervous as hell about picking him up because you're supposed to have a family member. And, legally, they're not married. So she's been fretting about it. And I said, you know what, Kelly Slater and Kelly Slater's professional surfer. You know what professional surfers do when they are out in a tournament or in the heat and their competitors? They actually just start laughing. They just start laughing and they'll start cracking jokes, even though they're a super competitive group of people. They'll start laughing, and laughing in a high intense situation actually relieves the stress in your body. And I thought about that because as we were on this call today, I had been buying put contracts on NVIDIA that expire today. And I was underwater as we got through Mark's thing. And I was like, just follow the trend. It's gonna break. The trend is gonna break. I'm watching a 5-minute chart. I'm watching it break. And I'm sitting there and I'm like, how do I relieve the stress? I just start laughing. I just start smiling and start chuckling, start to relax. I start to get in my groove the whole bit. And then all of a sudden the video just starts selling off. Boom, 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 boom. Walked away, clashed out. You probably saw me talking. I was sitting there trying to hit my sell button on my phone. 84% return. Boom, I'm out, done. But it's getting through the day every once in a while. You just got to laugh. You just got to chuckle. You just got to go,
So
fuck it.
I'm a little hurt. I'm a little hurt that I'm so boring that you have to trade during
No,
my
no,
week.
no.
I was really in a happy Christmas mood, and now my entire
Oh,
holiday's
come
ruined.
on. Oh, whatever. Yeah, I'm surprised you're not going, hell yeah. You followed you followed your program, dude. You followed your process.
Yeah, yeah.
Anyways, y'all are great. Thank you so much. Enjoy the life. It's a good one. We live in a great country. Peace.
Later, guys. Amen.
Yeah, we'll see you guys.
Amen
Thanks.
to that.
All
Okay,
right.
enjoy your
See ya.
holidays.
Merry Christmas,
Thank you.
everybody.
You
Happy
too.
holidays.
Yeah,
Bye.
bye.
Happy holidays.